All right, gang. So now that we've gotten a little deep in the game with year 11 decisions due tonight, we've gotten to the point where potentially you can make some pretty disastrous mistakes with regards to your capital structure. Most of you have correctly figured out that in order to manage the ever increasing expectations of your shareholders, and that is to say that they always expect your earnings per share, your return on equity, and your stock price to increase. In order to accomplish those ever increasing expectations of your owners, you have to repurchase stock. And each year, the number of shares of stock that you can repurchase increases a little bit. However, I want to point out a particular rule, if you will, in the simulation and give you some tips to deal with that. The particular rule that I'm talking about is kind of in small print, but it's down here on the last decision entry page, finance and cash flow, and with regards to shareholder equity. There's a mandated minimum that you should maintain at least $100 million in equity at any given time. Well, here's the deal, okay? The reason that you want to repurchase shares of stock is you use equity, that's to say equity, right? You remember the fundamental accounting equation, assets equals liabilities plus equity. Stated differently, assets minus liabilities equals equity. Well, equity is where the money's going to come from to repurchase your stock. And what you have to do is you kind of have to forecast your sales, and fortunately Globus is really good about that. They forecast your sales, they forecast your expenses, and it forecasts your net income, okay? So help me out here. Shareholders' equity can only come from two places in a business. The first place that equity can come from is from the owners, okay? So when you sell shares of stock, you're getting equity in exchange for ownership. You're getting equity on your balance sheet, and you're getting new owners, okay? The other place that equity can come from is from your earnings. When you earn money and you don't pay that money out, it's held in your equity accounts until at such time as you distribute that money, okay? So there's some stuff that you do know going into each decision round. You know what your beginning equity is. You know what that is. In this case, Globus actually tells us that for this particular company, the shareholder equity is $139.7 million. You know how much your dividend is going to be because you actually declare the dividend, and it's a very simple calculation. You multiply your dividends per share, right, times the number of shares that you have outstanding, and that tells you how much you're going to pay out in dividend payments. You'll see that estimated right here, okay? You also know how much it's going to cost you to repurchase shares of stock. If we don't repurchase any, our stock price is going to be $168.14. If we repurchase 100 shares of stock, and that's 100,000 shares, by the way, but if we repurchase 100,000 shares of stock, it's going to drive up our stock price. If we repurchase 200,000, it drives it up a little more, and the more stock that we buy back, the higher our price goes, okay? So that's a direct relationship. Your stock price increases by the proportion of shares that you're repurchasing, okay? So what you should notice is that every time you increase this number right here, okay, I'm not pressed enter yet, it decreases this number down here, shareholders' equity, okay? But that's kind of a given, right? You tell Globus how many shares you want to repurchase. You tell it how many you want to repurchase, okay? And it calculates what the cost of that repurchase is, and that money comes out of equity. So honestly, the only piece of information that you're missing here is net income, okay? Because if we take our beginning equity and we add any stock issues, and you're not doing that right now, remember? If we add stock issues, that would increase our equity. If we add our net income or our profit, that increases our equity. If we subtract our dividend, that decreases our equity. And we subtract our stock repurchase, that decreases our equity. The only piece of information that we're missing to get our ending equity is what's our net income, okay? And now, for multiple reasons, I want you to get your shareholders' equity as close to $100 million as possible. There's a very simple reason for this. The formula for return on equity is literally return over equity. And another word for return is profit. Okay, so return on equity is literally your net profit divided by your average stockholders' equity. Okay? And for average stockholders' equity, it's beginning equity plus ending equity divided by 2. Since equity is the denominator in that return on equity fraction, the lower you get your shareholder equity, the higher your return on equity goes. Okay? So watch this. I'm going to put stock repurchase at 0. And do you see that return on equity is 57.8%? If I put stock repurchase at 500,000 shares of stock, watch what happens to return on equity when I hit enter. You notice how return on equity jumped from 58 to 75%, and ending shareholder equity decreased to 140 million. If I put in 700, okay, it decreases to 104.3. So you've probably got this question, how low should I go? Now, obviously, you don't want to go below 100 million. There will be consequences if you do. Namely, that I will fine you. What do I mean by that? As the administrator of the game, if your ending equity drops below 100 million, you're spiking the results of the game unfairly. So whatever amount you drop below 100 million, I'll fine you that amount. If you drop your shareholders' equity to $90 million, you'll get a $10 million fine, and then I'll take that $10 million and divide it among the other 5 teams. Okay? So let's say if we try to go to 800,000 shares of stock, you get this error message. Your recent entries cause the projected shareholder equity balance to fall below $100 million. Dividend payments require a minimum shareholder equity balance of $100 million after the payment is made. Therefore, the dividend has been reset to 0. So you see what happens there if you try to repurchase too much. But what actually happens is if you do not meet your projections, it's going to drop below 100 million. Okay, because this is based on a perfect world, assuming that we meet our sales projections, our expense projections perfectly. We'll have $105,803,000 in net profit, giving us shareholder equity of 104 million at the end of the year. But let's say that we miss our earnings results by $5 million. That's going to drop us below 100 million. Okay? So here's what I recommend you do, and it's very, very simple. You need to look at the bonus point awards page in the Camera and Drone Journal, and you need to see how well you have been meeting your investors' expectations for earnings per share. Earnings per share is the same thing as profit, except it's just adjusted by the number of shares that you have, right? Okay? So you want to look at year 10, year 9, year 8, year 7, year 6, okay? And what you'll see is in year 6, Team D missed by 14%. In year 7, they were perfect on their earnings per share projection. In year 8, they missed by 4.4%. In year 9, they missed by 3%. And in year 10, they were actually 5.7% better than their projections. So taken together, you may say, hey, this Team D is really good at meeting their projections. Therefore, I don't need to give myself any cushion. Okay, so if that's the case and you're that confident that you can meet your projections, then you could actually come in here and repurchase the perfect number of shares of stock, okay? 723,000 in this case, with a dividend of $1.10. That's about as close as you can get. That's 100.2. Okay, that's 100,200,000 in equity. I don't recommend you do that, even though you're going to get the best possible return on your equity, right, at 88.2%. The danger is that you'll miss this minimum, okay? So why have I given you this 10-minute video? Here's the deal, folks. I don't want you to get fined, okay? Because if I fine you, your performance is overstated, and I'm going to give that money to the other teams whose performance is understated relative to you, okay? So you want to give yourself a reasonable cushion, and you have to define how much reasonable is, right? Maybe reasonable for you is 20% of earnings. You can see your net profit projection here at 105 million. Roughly 20% of that is what, $21 million? And if you want to give yourself a $21 million cushion, then you leave your shareholder equity at about 121 million, right? Okay, so that'd be a lot like repurchasing 610,000, 608,000, somewhere in there. Okay, that gives you that $21 million cushion. So you want to repurchase as much stock as you possibly can while keeping your credit rating as good as possible, right? By keeping as much money in the bank as possible, by keeping your debt to equity in check, your interest coverage in check, and your current ratio in check. You don't want to go under 100 million because that's a very costly fine, okay? I'm just now bringing this to you. The only reason I'm just now recording this video is we have just now really gotten to the point where you're capable of making decisions that would drop your ending equity below 100 million. We've come close. Team A was at 103 million at the end of year 10, or end of year 9 rather, okay? And 126 at the end of year 10. We've gotten close, but now we're to the point where you can really damage yourself, and I don't want you to do that, okay? All right, thanks for watching.